Hello, everyone, and welcome to today's major markets update for Wednesday, August the 3rd. A new little format, no new slides. Every slide is going to be the same. So please remember Jesse Livermore's 21 trading rules. Adheres to that as much as you can or learn from them. Remember, nobody is right all the time. Please be aware of those that say they're right all the time, and then when you check their work, they're wrong all the time. 70% reliable, that's as best as you can get, 95% accurate. There are many ways for you to capitalize on my insights and my work. Please read more about Elliott Wave if you need a refresher. Look at the how-to videos, especially regarding corrections, which can always last a lot longer. As always, after 3 waves down, expect at the minimum 3 waves back up because we can get a triangle or a flat. Do my trading system alerts, the ETFs, secret service. There's many ways for you to profit from those. We're up thousands and thousands of dollars already in a month. And of course, you can all do it yourself. There's many ways to profit from it. Don't use anything, that's on you. Use it all, that's great. Whatever you want to do. But this webcast and these updates are only one of many ways to make money. Okay, I want you to make money. I don't care so much about all these subscriptions. I honestly can close the doors and I'll be done, okay? I really want you to make money and trade easy. There's nothing easier than being told what to do, but I know everybody's different. That's good. That's what makes the market. It's just another flavor and a way to make money. That said, please, let's move on to the Dow Jones. The Dow Jones is now back above the Ichimoku cloud. I'm presenting here the traffic light because it went from full-on red here in April, May, June, July, to almost green. We're only below the 200-day moving average. So slowly the moving averages are turning back up. Prices above the 10-day, the 20-day, and the 50-day, just below the 200-day and above the cloud. If anything, the current price action looks much more constructive than in March. So here is still my wave count, 1A, 2B, 3C. This is on a closing basis to about 33 to 20. Looks like we have a nice subdividing wave 3 on our hands. We might have a 1, 2, 1, 2, 3, 4, 3, 4, 5, and then a 4, and then a 5. So this still remains my preferred path. I have no indication wave 3/C has completed. We need a multi-day to multi-week pullback. Here we had a flat wave 2, so wave 4 is likely going to be a zigzag, potentially a triangle. So still looking good, still tracking nicely. We had the breakout held. Starting to see a little bit of negative divergence here on the RSI 5, not confirmed. Kind of starting to get overbought on the money flow. And as you know, once everything is bought, only selling is left. Here is the NASDAQ100. And what I like here is the upside surprises. We now have upside surprises instead of downside disappointments. So the flavor of the market has changed. Looks like we have a subdividing wave 5 of C of 3 on our hands. We have surpassed already the 161.8% extension. So we had the potential to go lower. The market decided not to. And now that we've cleared 15,300 and of course cleared the May-June highs, I think eventually 15,300 plus is a given. So what we now need to see is a wrapping up of some potentially nano waves. I'll show you those for the semiconductors as well as for the S&P 500 to wrap off this microwave, okay? And then we complete 3, we're going to get a 4 and a 5. So the only thing is that we need to revise our upside targets, which I will do here in a minute. Please be advised, I will not share these slides. I share the slides or the charts, better said, in my other updates. So please be advised. So we're going to get something of a pullback, and the pullback might not be as deep there, and then we might get a even higher wave C3. To be determined. I haven't even been able to clear the notion of a wave C/3. Remember A, B, C, or 1, 2, 3, 4, 5. We don't know beforehand how much it's going to be, but it looks like we need a pullback soon from overbought, and then another rally, potentially set up negative divergences on the daily technical indicators, as I showed you for the Dow Jones, that will then set up this larger B/2, which should probably be a month-long affair, something like that. So here's the semiconductors with the updated wave count, a more bullish wave count. In blue were the wave 3, the wave 4, and the wave 5 target zones. In this case, green 3, green 4, and green 5. We have exceeded it. This breakout suggests that we're dealing with a subdividing wave 1/8. Subdivisions can always happen. Okay, we have to be cognizant of those. That they can happen. We don't know them beforehand, but we have to be cognizant. Then when you get the breakouts, they happen. So if you say, well, I sold here, okay, that's okay. Then you can always buy the breakout and try for another leg higher. Okay, taking profits is never wrong. What I prefer to do is partial selling and raising stops. I think that's much better than throwing everything but the kitchen sink at it, or throw the baby with the bathtub or whatever bathwater out. So always rather raise stops and sell partial profits than completely reversing trade. Do not reverse trades until confirmed. In this case, we did not break below the previous day's lows. We need to break below previous day's lows to start suggesting that a new downtrend has started. So this looks rather good. The subdividing wave 3, 1, 2, 3, 4, and then wave 5 is further subdividing. 5 of 3, 4, 5. This is now the green path is my preferred path. If we break below, I would say 28.70, then we're going to go straight to 2B and then blue. So the green-blue path is preferred. The red-blue path is alternate. And again, I like it. There's upside surprises versus downside disappointment. It really tells us the environment and the market has changed in behavior. Again, we don't know if it's going to be 3 waves up or 5. I prefer 5 larger waves, but to be determined. Once we get 5 green waves up, we know that the next leg lower will be 3 and be followed by another leg higher. After 5 up, expect at the minimum 3 down and another 5 up. In this case, because of the bounce. So here is the S&P 500. We went nominally above the 4150 target zone. A while back, I already said we would target about 4100 plus or minus 10. So we got there, we've exceeded it. That's great. Again, upside surprise. It looks like we have a subdividing wave 5, potentially wave C, of 3 on our hands. 1, 2, 3, 4, and now this is then femto, I believe it comes after nano. 1, 2, 3, 4, 5, and expect wave 5 of 3 to target somewhere in the 4200s. So we should see a short-term pullback and then one leg higher for this ending diagonal in blue, wave 5 of 3. And then we see the wave 4 and then another wave 5. That is the preferred path. And then, of course, the target zone for wave 4 gets raised because the index moves higher. Again, upside surprises. I start to like it. This is good. Then we have a very clean, clear path on our hands. 4, 3, 4, and 5 to complete 1/A, 2/B, 3/C. So bigger picture wise, I expect over the next couple of months much more upside. I'll also show you why based on some market breadth indicators. For now, so very short term maybe bearish, shorter term still bullish, intermediate term bearish, and then longer term bullish once again. Here's the IWM. Haven't changed anything on it. We're kind of subdividing for this green wave 5 higher. Still in the ideal wave 3 of 1A target zone. Still looks good, upside surprises. The breakout held and we're moving higher. Again, this is the ideal Fibonacci-based target zone. The market doesn't have to be ideal. Just as it wasn't for, let's see, the NASDAQ as we're breaking higher as well. You don't have to stall at 106.8. You can always go to the next Fibonacci extension and the next one. So always keep then an eye on, are we starting to make a low below yesterday's low, especially a close. Intraday, not too important. It's the first warning, but you really want to see this close below the previous day low because then we have switched from higher highs and higher lows to all of a sudden a lower low. Again, S&P 500 looks good for an ending diagonal, nano 5 of micro 5 of minute 5 of whatever 5. So I still expect a little bit of upside, maybe first a little bit down, up, then larger down, larger up, much larger down, much larger up. Okay, that's the bigger picture path on the S&P 500. It's still my preferred path. Let me show you that on the daily time frame. Once again, I've shared this chart with you many times. I can find it real quick. No, not this one, maybe this one. There. So we should see this 1, 2, 3, 4, 5, 1, 2, and then of course another leg higher. IWM, just covered that one. So everything still looks good, bullish. Again, shorter term, maybe a pullback soon for a smaller wave 4. And after 4 comes 5. That's the ideal path. And then we should see a /B/2 type of correction, followed by a /C/3 type of rally. So here are some market breadth indicators. This is the bullish percent index for the S&P 500. It sits at a healthy 74%. So we went all the way from almost 10% to 70%, meaning that 74% of all the stocks in the S&P 500 are now on a buy. So it went from completely washed out to good strength. Same here for the NASDAQ100, went almost from 0 to now 80. So that's a good sign. The advanced declining line for the NYSE broke out here above the downtrend line that's held all the upside in check since pretty much 2022. As you can see here, this is my cursor. So that's good. And now we're at the next downtrend line. If we break above it, then this whole downtrend has ended from a market breadth perspective and also from a index perspective, and we're in a new uptrend. Again, the uptrend can be a larger bounce, ABC, multi-month rally, with of course an A now underway, a B to follow, and then another leg higher C, or it is the initiation of the new bull market going to new all-time highs. To be determined. I'm not certain about those two yet, but I know that then the next larger pullback, the wave 2/B, will be a good buying opportunity for the leg 3C. Right? Baby steps, one step at a time. No need to get greedy, pigs get slaughtered. So here is the new lows. It's at a healthy 25 for the NYSE and a healthy 27 for the NASDAQ. I want to see these low levels, and I want to see those low levels continue like we saw in 2020, 2021. So we've really now reached these levels where I say the market is getting harmless levels, but it needs to hold. Here is the put-call ratio, a little bit anemic, nothing too bullish yet. So there's still potential for more upside before things get too frothy. As again, you can see how nice market turns are measured by dips in this put-call ratio. But it doesn't look too great yet. So there's nothing that always works all the time or is equally bullish as everything else. Here's the PMO buy all, sell all indicator. Again, this one is not flawless either. Are some serious misses on it, but some serious good calls as well, which is the recent buy signal in late June. It's still holding, no sell signal. Still room for upside left. I have no sell signal. Now let's look at the percent of stocks above their 50-day moving average. I think it was almost a month ago, if not more, I reported on this one that it reversed from below 2.5 to over 20, which was a buy signal based on history. Okay, we have data available over the last 20 years, and that gave, I think, 5 different signals: a buy in 2020, a buy in 2019, a buy in 2011, and 2002 and 2009, with the notion that there were occasions where we had a bounce, a slightly lower low, and then a massive rally. So far, we have had no lower low. So that looks good. That ratio, or that indicator, can be divided by the number or percentage of stocks above their 200-day moving average. So you get a ratio. Okay. If that ratio of the number of stocks above their 50-day divided by 200-day goes from 0 to over 1.75, we often get a breadth thrust. We had it in 2020, 2019, 2016, 2011, here in 2009, a failed signal here in 2008. We had a good signal in 2003. We had a good signal here in 2002, and a decent signal in, again, 2002. Decent meaning that there were also these instances where we first went a little bit lower, like in 2009, before moving significantly higher. Bottom line is this supports this other breadth thrust I just mentioned for continued upside. Now note that, of course, the rally in 2009 here in this ratio was massive. Okay, we went from 0 to 25. This is the difference between a generational bull market low, in this case, in my humble opinion, cycle 4, versus all the smaller dips within the cycle 5 we're currently in. Okay, again, the current dip or a rally, sorry, in this index is once again not indicative of a large multi-year bull market or multi-decade bull market, pretty much. That we had in 2009. So this one is still of the flavor like we had in 2020, 2019, etc., meaning we should see a multi-month to multi-year rally. To be determined, but this is not a predictor in how high prices are going to go, how long prices are going to rally. This simply supports the notion that we should see higher prices going forward, with, of course, the usual dips in between. That we cannot, of course, exclude. Nothing goes up straight in a line. Nothing goes down straight in a line, okay? So we will have the waves unfold. So easily we can have wave A complete, wave B, and then a wave C that's going to last for quite some time. And wave C can challenge the all-time highs. That remains to be seen. All this says is that we had quite a thrust in breadth from pretty much 0.15 to over 1.75. So the market has reversed really, really hard. We did not see any such thrust since the all-time high in January 2003. So this is also supporting the notion of a significant change in trend. As I showed you for the IWM, a significant change in trend because we've broken above the downtrend line. Okay, significant change in trend for the Dow Jones because we're back above all the moving averages and the cloud and all that stuff. The trend, of course, is longer term. Within the long term, we can have some serious corrections, which we'll capture with the Elliott waves. So I remain bullish for the intermediate to long term. Shorter term, we might need to see some wave 4, wave 5 type of pullback. Again, the shorter term is always more variable. Statistically, you have a 58% chance for tomorrow being an up day. So you only have an 8% edge as a bull versus a bear. It's almost flip of a coin. So it's always hard to exactly know what tomorrow will do, but might get a little bit of a red in there over the next few days to then complete very small fourth and fifth waves to complete this 3, 4, and 5. So please remember, if I show you the green 3, the green 4, and the green 5, that those are part of a larger wave, which are part of an even larger wave. So that's the fractal nature. So please consider your trading time frame. If you have difficulties with it, again, use my ETF trading service, use my secret service. It's hard to go wrong. It really is. Why? Because we have stops in place and we trade according to risk profiling of the market. If the market is in a downtrend, you take small positions. It's in a strong uptrend, you take large positions. Please keep that in mind. So that's all I have for today. Things are nicely on track. I like the fact we're moving higher than what we would like to see ideally based on Fibonacci extensions. The market doesn't have to be ideal. Upside surprises, I continue to remain bullish. I expect some pullback soon for 3, 4, 5 to complete a larger initiation move. Take care, trade safe, and be on the watch out for the email tomorrow. Bye.